Hi, I'm Vishnu Srinivas, and welcome to Hawkeye. I started this podcast to give professionals an open platform to share their candid views on topics impacting businesses and economies around the world. Make sure to rate, review, and subscribe. Joining me today is Michael Green, Chief Strategist and Senior Portfolio Manager for Simplify Asset Management. Thanks so much for taking the time to speak with me today.
It's my pleasure, Vishnu.
Awesome. So, do you want to get into a short background about your role?
Well, you don't get to be my age and have a short background, but long story short, like you, I went to business school for undergrad. I went to the University of Pennsylvania's Wharton School of Business, which many consider second, of course, to Michigan. The graduated from Penn in '92, went into management consulting, a firm called Bain and Company, and then left with some senior people from Bain and Company to start a firm called the Parthenon Group, which is now part of Ernst & Young. While there, I developed a bit of an expertise in advising corporations to the extent a 25-year-old can have expertise in anything, but I developed a degree of expertise in valuing companies with internal business units for strategic planning purposes. So worked on a number of acquisitions and divestitures, decided that there was an opportunity to codify a lot of the tools and processes that I used for those valuations into a software package to be marketed to strategic planning departments and consulting firms. That actually, interestingly enough, led to my being found by a guy by the name of Mitch Julis, who was one of the founders of Canyon Partners. He asked me if I could link our valuation engines to the public equity databases at Compustat, and suddenly we had a product that could be marketed into the investment management business. We did that for a couple of years, sold in 1999, and ultimately it was sold to Credit Suisse. Today, you might know the product if you ever work on a Credit Suisse desk or have access to their research. It's called the Holt system. It's an automated valuation tool built primarily around the concepts of economic profit, what used to be called EVA or CFROI. I used that sale as the opportunity to transition into the asset management business, decided to approach the world from the standpoint of being a value investor, thinking that I had unique tools and insights in terms of the way to value companies. And that was just a phenomenal introduction to how little you know, even once you hit 29, right? And you're suddenly put into a situation where you're trying to manage as a small cap value manager. I joined one of my clients in the teeth of the dot-com cycle. And so was really, really fortunate that I came in at the end of that cycle. So there were only about 9 months left in that cycle. Those 9 months were incredibly painful for me, but an incredible learning experience as well. And from that point, it created some real opportunities as both my performance was very strong and the firm's performance was strong. That led to me being recruited down to New York to manage larger sums of capital, initially for a mutual fund firm called Royce and Associates, which still remains, in my opinion, the single best stock picking environment I've ever worked in. And then I was recruited out of Royce by Canyon Partners again, a decade after I had first met Mitch Julis. He approached me with the idea of launching a New York office of Canyon Partners, with me leading that initiative. Over the next 8 years, I built that from basically myself in a room running an allocation of equity capital to a broad team of about 15 people running about $5 billion in total assets. And then I was actually lifted out of Canyon Partners by the team at Soros and given the opportunity to launch my first hedge fund, a firm called Ice Farm Capital, which was a phenomenal experience. Again, both in terms of the dynamics of the difference between managing money, particularly when you're utilizing all the resources that somebody as brilliant as Mitch Julis or Josh Friedman has put in place for you at Canyon Partners, and the actual process of running a money management business. It's much harder than it looks. The process of managing money is relatively easy compared to the process of herding the cats and dogs that comprise LPs, GPs, employees, etc. After a couple of years of that, I ended up switching over to managing the personal capital of Peter Thiel. And that was a blast, a fantastic opportunity to come back to the West Coast for a while, work with some of the most interesting people in the world. And it was during that period that I think I kind of became known to the public initially through some of the work that I did with a firm called Real Vision, and then through my role in the implosion of what's called of XIV, what's called Volmageddon, in my employment for Peter, and then have successfully successively moved on from there to my current role at Simplify, where I'm the chief strategist and senior portfolio manager, actively running about 12 products that are now traded in the ETF space and taking advantage of a regulatory change that was introduced in September of 2020 that allowed many of the traditional hedge fund strategies that I used in my career at Canyon Partners and Ice Farm and for Peter Thiel to be incorporated into ETFs, something that really didn't exist prior to 2020. So that brings us up to date.
Yep, and you've definitely been all over.
I have a true mutt.
Yes, but we're sure to get to your profuse love for passive investing later on.
Oh, good.
But let's start off with this past week, because last week it finally happened. We saw the 2 quarters of negative GDP that people are, I guess, have been expecting for quite some time. And a couple of days ago, we saw 3-month 10-year Treasury yield curve also be kind of going towards being inverted. These obviously aren't be-all, end-all metrics. There are still debates over whether we're in a recession or not, but where do you think our current economy is heading?
So I personally think, I mean, the work that I've done suggests that we're actually in a recession. I think that we'll end up seeing revisions that pull us into a recession starting in this current quarter. There's some questions about what the third quarter is going to look like. I think that obviously there's elements of snapback. We've had inventory reduction as a primary component of the decline in GDP. Just to remind everyone, it's the change in inventories as compared to the absolute level of inventories that matter. And so as businesses have tried to work down inventories in the first and second quarter, it's likely that process, that pace slows. They stop working them down as fast as they've been trying to. And that should contribute some positive dynamics to a GDP report that may break that 2-quarter trend. I think it's very hard to know, though, because when you have such high inflation, by far the biggest swing in the declaration of positive or negative real growth is going to be the assessment of the inflation number, right? So the simple way of putting it is that we have very low real growth, likely negative, and there's also just a ton of stuff that I would describe as residual from the first quarter that is keeping the NBER from being more constructive towards it, right? Some confusion around things like non-farm payroll employment versus the household survey. The household survey is a broader measure. It doesn't just statistically survey establishments. What we have seen, and this has been a long-term trend, we've seen more and more people moving out of the self-employed and small proprietor space, which shows up more in the household survey, and into the non-farm payroll. Non-farm payroll doesn't do a great job of distinguishing between people who have gotten 2 jobs because they're working 2 part-time jobs, et cetera. So there's some confusion around that I think will ultimately get worked out. But the bigger question that we have right now, and the bigger challenge that I would just describe for the U.S. economy, is broadly speaking, wages are not keeping up with inflation. That's leading to negative real consumer spending power. Consumers have tapped into things like credit cards, et cetera, to maintain their standard of living. That seems to be running out. We're beginning to see unit declines in purchasing now that are causing things like inventory to sales metrics begin to spike. We're seeing this in in housing construction and everything else. And that generally is a pretty good indicator that we are moving fairly rapidly into a slowdown. That, I think, is the biggest thing that most of us who are watching this, I'd be actually really interested in your father's take on this, because he's one of the most thoughtful guys I know on this sort of stuff. But the underlying dynamic is that what's really shocking here is how fast things are slowing down, right? It's not that things are slowing down. It's not that they're drifting lower. The language that we're getting from many of our discussions with corporate leaders is it's like a light switch went off, right? And that's particularly true in the housing and construction sectors. I think it's becoming more true in the auto sector. Almost anything that is interest rate sensitive is just being absolutely hammered.
Right. And so what is the threshold for what the Fed is doing? Like, can they just keep hiking interest rates? Is there like an inflation number or CPI like metric they're aiming to reduce? Do they have like an actual plan?
Well, there's a whole bunch wrapped up in that very specific question, right? One, I think that they think they have a plan, but I think that broadly I would describe their understanding of interest rates as very different from the way I think of interest rates. And so when the Fed talks about something like a neutral rate, the way that they describe it is built around an aggregate. And I think this is one of the areas where I differ from most people who are involved in economics. I tend to be very uninterested in aggregates and very interested in the subcomponents of them, right? And so when you think about it from an aggregate standpoint, a neutral interest rate is basically the mean in a normal distribution, right? It's where it's neither stimulative or it's neither nor contractionary. But that's not really how interest rates work, right? Interest rates basically become a floor against which refinancings are done, right? And some businesses, 1 basis point over that floor is enough to send them into significant distress. And other businesses, you could accommodate 10% higher interest rates, right? Or 10 percentage points higher interest rates. I guarantee you that Microsoft is not sweating the current interest rate environment, or Apple in many ways sweating the current interest rate environment. In fact, given their net cash positions, both of those companies are likely, or their significant cash positions, both of those companies in many ways are actually happy to see higher interest rates. But many of the companies, the smaller companies, particularly private, those that have been bought out in LBOs, those that are in the smaller cap indices, et cetera, have significant stress associated with interest rates. And in fact, if you look at the Russell 2000, I want to say something like 30 to 40% of the index today is what I would describe as zombie companies, companies that are spending 100% of their free cash flow on very basic maintenance rather than growth opportunities, and paying their debt load, not even paying down their debt load, right? The issue is if you push those companies over the edge and understand that for those companies, what we have seen is a full doubling of their cost of capital in the past, give or take 9 months, right? So that's just an extraordinary change. Those companies employ people. And so if those companies fail, those people lose their jobs. And if they fail to invest, the industries will further consolidate. And that's one of the real challenges that we're seeing. I would argue, 40 plus years into the Reagan Revolution and the Bork doctrine around the dynamics of FTC and antitrust, we've seen an extraordinary concentration of industries, corporate employment, et cetera, that hiking interest rates is just going to make worse, right? It hands more market power to the larger and larger firms.
Right. And I know you had a take recently that you don't want the ultimate goal is to reduce consumption, but you might accidentally end up, reducing investment more. Is there like a policy that is better suited to avoiding that than what their current?
100%. And that's, this is one of the challenges. Anytime I say anything favorable about the Fed, by the way, people like jump all over me. Because everybody wants to hate the Fed, but the reality is the Fed is basically an enabling drug dealer for Congress right now, right? Congress is the one that should be getting out there and saying, okay, these are the priorities, or the executive branch could be doing the same thing. These are the priorities that we choose to focus ourselves behind, right? And so we're going to adopt industrial policy that encourages divestment from China, that encourages reshoring of manufacturing, that encourages increases in energy production, et cetera. The use of interest rates as a tool to try to slow the economy is predicated on what's called the Euler coefficient, right? It's the relationship between interest rates and consumption. And the simple reality is that there is no relationship, or certainly not a positive relationship, right? So hiking interest rates, you're a rising junior at Michigan. My guess is not once when you went to go out with your friends did you say, geez, what is Fed policy today?
Probably
right?
not.
I'm 100% certain that you didn't think about it, nor for that matter does Fed policy meaningfully affect the forms of credit that you have access to, which is largely credit cards, right? So Fed hikes interest rates by 75 basis points. The interest rate on your credit card goes from 18 to 18.5%, right? But who cares, right? It has no effect on consumption in that manner. What it has a huge impact on is investment, right? And in particular, it has impact on things like housing, investment in productive equipment, capital equipment. If you're an oil and gas company and you see that the US is trying to slow the economy dramatically, potentially tipping it into recession, do you choose to drill the well today, or do you say, you know what, let's wait 12 months, right? That waiting 12 months reduces employment, reduces consumption. But when you wake up 12 months from now, you realize, oh my gosh, we're even further behind the curve in the oil and gas sector. We have even less investment in energy than we would have otherwise had. And as a result, I just think this is a really inappropriate policy tool to be using to try to slow this type of inflation. If this were an inflation that was being driven by excessive quantities of consumer spending, right, which we're not seeing, we're seeing real declines in consumer spending, we're seeing real declines in personal income, then that might be the appropriate policy. But when the reality is what we're facing is shortages being created by logistical snafus, the terrible decision to shut down our economy and then try to wake it back up with insane amounts of stimulus, like this doesn't work. It just doesn't work. I mean, go back and look at the interest rate history in prior scenarios of wartime type economies. Please find me a situation in which the solution was, let's hike interest rates. Because when you face these adverse conditions, credit spreads are already blowing out and raising the cost of capital for everybody that is on the margin anyway. Compounding that by sending the signal that your objective is to do this, and to do it using tools that have long and uncertain or variable lags associated with their impact, this is just insane.
Yeah, and speaking of the Fed, Michael Ang on Twitter wants to do a little hindsight activity. And I think you touched on this just a few minutes ago, but he's wondering if the Fed hadn't monetized this huge fiscal spending they did in response to COVID, would inflation be different now?
Yes. I mean, part of where I saw some of this come in very quickly is what we actually did was a huge injection of equity into the business, into the corporate sector, right? So PPP loans, which were taken out and then forgiven, effectively is just a giant corporate grant, right? It was an extreme form of stimulus. Similarly, the dynamics of support that we provided to households, et cetera, while I believe ultimately much of it was necessary, again, was a very blunt and aggressive tool that was probably overutilized by the Biden administration in the first quarter of 2021, when it became fairly obvious that things were not, we're not facing the sort of conditions that we had seen in early 2020. I think that absolutely contributed, but part of the problem that I have is you can't make that go away.
Yeah.
Right. And you've probably heard me say this at this point over and over again, but I keep hearing people using this language. It's like, well, they have to completely reverse that, right? They have to, do the exact opposite now. And it's like, wait a second. You objected to an interventionist Fed then, but now because they're engaged in some form of hellfire and brimstone that you personally think, the economy deserves in some way, you're suddenly in favor of an interventionist Fed, right? You don't get it both ways. The right answer right now for the Fed is stop, just calm down and actually see what the status is, because we don't know. We genuinely don't know what it is.
Right. And it's easy to bash the Fed, I get it, but also, we do have to think in terms of just logic, and things aren't as black and white as reversing and then swinging to the other end of the spectrum. Shifting gears though, we need to talk about something that you've been quite passionate about over the past few years, that is passive investing.
Yeah.
So I guess to start off, what do you think has attributed, now that you look back over the past half decade, I guess, or so, what do you think is attributed to the rise in passive investing we've seen?
Well, I think that there's a couple of things. One, there's just a deep fundamental misunderstanding of what passive investing actually is supposed to be versus what it is. If you go back and you read Bill Sharp's 1991 paper, The Arithmetic of Active Management, there's footnote number 4 there that defines how a passive investor plays, right? So in the paper itself, it describes a passive investor as one who never transacts. Right now, this obviously is fine in a single period model as he's effectively modeling in that dynamic. But in footnote 4, they note that, that means that getting into the market occurred outside of this observation period and getting out of the market occurs outside of this observation period, right? Vanguard and BlackRock receive well in excess of, between the two of them, somewhere in the neighborhood of $2.5 billion a day in inflows. Just to put that in perspective, that is a large hedge fund being created every single day by inflows into BlackRock and Vanguard, right? Every single day. Simplifies one of the most successful ETF launches of the past several years. In the past year and a half, we've basically grown by about $1.5 billion, right? I receive congratulations for that all the time, and I remind people that's one day of Vanguard's inflows.
Congrats still.
Oh, congrats. Yeah, I managed to do it with one day, right? What I can do in 18 months what Vanguard did in one day. The reason why I bring that up, though, is not to, engage in sour grapes over that component, but it means by definition that Vanguard and BlackRock can't be passive investors. What they are active investors with the world's simplest algorithms. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. That's it. That's the entire passive game as it exists right now. What should I buy? Well, I'm going to buy everything in proportion to whatever its existing market cap is. What should I sell? I'm going to sell everything in the exact proportion of its existing market cap. Should I buy things that are cheap? No, I have no idea what that even means. And for that matter, the algorithms that effectively are embedded, a market cap weighted methodology, by definition means that the next $1.5 billion that comes into Vanguard's funds buys more of stuff that goes up and less of stuff that goes down, right? So it reinforces momentum characteristics. It's an anti-value strategy, right? I, as a discretionary investor, react to the price of something going up, all else being equal, by saying, well, that makes it less attractive as an investment. The Vanguard and BlackRock methodology, or passive methodology to be more broad, it's not really the fault of either of the firms. Their methodology assigns the exact opposite weighting. Something that goes up by definition is more attractive, right? Now, you can make a case for that in a market that is dominated by active managers and under the theory of the efficient market hypothesis, right? That the current prices largely reflect the accumulated knowledge of all participants in the market. And so when something goes up under an information theory framework, right, which would be an extension of the efficient market hypothesis and consistent with things like Grossman-Stiglitz paradox from 1982, you would think that something going up means that there's better news ahead, that some informed trader has driven the price up, right? Well, that's not the case if passive is the dominant player, if their flows are actually reinforcing and enhancing these moves. And so that's what I think is going on when I talk about passive, right? We're creating conditions under which the markets are increasingly disassociated from the information theory and increasingly focused on the larger and larger flows that are going into and out of passive vehicles.
Right.
Go ahead.
Yeah, no. So, I just want to build off of what you just said, because, I know from intro finance, the assumption that markets are efficient is not entirely, we can't completely buy into that, because we've seen, I think there's enough evidence to say from popular investors that markets can be beaten in some sort of way. So, is the principle of passive investing really just built on that?
So the principle of passive investing requires efficient market hypothesis to be true. Now, you can make arguments around whether it's strong form or weak form, right?
Yeah, sure.
And whether the inefficiencies associated with the costs of active management are high enough to offset the advantages of even a weak form efficient market, active stock selection in a weak form efficient market. But the real problem is actually the thesis or the hypothesis or theory behind price formation in a passive or in an efficient market, right? So if you go back to the theory of the efficient market, or you go to the Grossman-Stiglitz paradox that effectively describes the limits of market efficiency because of the rewards that accrue to people who are capable of doing hard work and identifying mispricings in a market that other people are not doing the work in, right? The problem is that they require certain assumptions. And the single most important ones are what's referred to as the elasticity of the market. In other words, how much do prices change for an increase in supply or demand, right? And the second is the description of the universe of market participants. All of the historical models make assumptions that the individual that there are two components. One is markets are highly elastic, right? So, and that makes sense, right? Because when I buy, you sell, by definition, cash is unchanged, right? My cash goes to you, your cash goes to me. And so theoretically, there's been no change in the system. Most models of the efficient market assume that $1 into the market creates something like a 1 penny increase in market cap over and above that dollar coming in, right? So that dollar going in creates $1.01 of incremental wealth. In 2020, there was some work by academics, Xavier Gabbay and Ralph Koijin. Gabbay is at Harvard, Ralph Koijin is at University of Chicago, both second-rate business schools compared to Michigan. The work that they did is labeled the inelastic market hypothesis. And what they did was they actually went in and mechanically examined that assumption. And they discovered that $1 going in doesn't create 1 penny of wealth, it creates $5 of wealth. In other words, the efficient market hypothesis is misspecified 500 to 1 in its elasticity analysis. The second component goes back to the Grossman-Stiglitz paradox, et cetera, which is the ability of individuals to influence the direction of prices given improved information. And their models ran under a similar elasticity framework, but also added a second requirement that is embedded effectively within the efficient market hypothesis, although not explicitly stated, which is that all the market agents have similar endowments. In other words, they're of similar size, right? Now, that'd be the equivalent of me saying, okay, I have the same amount of capital, you have the same amount of capital, we disagree, therefore we're going to each impact the price in proportion to that capital relatively equally. We can have a disagreement in the market, right? But when you introduce players whose endowments are the size of Vanguard and BlackRock, it's absurd, right? I mean, they are receiving 100+% of all the money coming into the industry right now, right? What that means is everything you're seeing in buying is on net coming from passive, and everything you're seeing in selling is on net coming from active managers. The passive managers have a momentum bias. The active managers tend to have a value bias, right? By and large, this actually explains why we've seen the extraordinary outperformance of momentum or growth relative to value for a period of time that was unprecedented in history. And actually, at Michigan State, which is another second-rate business school compared to the University of Michigan, there's a professor there, Zhang, who wrote a paper called, I'm going to get the title on this wrong, but it's Value-Weighted Indices, right? And it's something like Value-Weighted Indices, the implications of passive investing. What they do is, what Zhang and his co-authors did was actually examine exactly this feature, and they find exactly as you would expect, that periods of passive inflow lead to the compression of the traditional Fama-French factors. And then when something changes, it can cause a momentum shift that effectively is like a beach ball popping back above the surface, right? Value suddenly outperforms to an extraordinary degree for a brief period of time, similar to what in the industry is referred to as a momentum crash, right? And then it stops again and it goes right back to being suppressed. And I think we just saw one of those examples, for example.
Yeah, I think this dichotomy between momentum and value, like in breaking it down into like passive and active, is really an interesting concept. All right, so your Twitter followers weren't going to let you get away without getting your thoughts on some of their questions regarding this. So starting with Jeff Sharp, No relation to Bill Sharp, by the way. I don't think. Wants to
I
know.
don't know either, but yeah.
Wants to know what the impact boomer retirements will have on passive flows, including the growing number of boomer target date funds that will
Yeah.
be subject to minimum required distributions. And to be clear, I think already like many like 401ks already like invest in these like use passive flows and target date funds, to my knowledge.
Yeah, so he's hitting on a really critical point, right? Which is the dynamics of wealth accumulation is that wealth is also just tends to be a proxy for how old you are, right? My guess is your bank account is smaller than mine. My guess is you own fewer houses than I do. My guess is you have a smaller 401k than I do. And if you do have bigger than I do, congratulations, that's phenomenal, right? But that's not a function of skill or anything else. That's just a function of age, right? I've contributed to 401ks for 30 years now, right?
Right.
There's two interesting components of that. One is when we talk about passive investing, most of the data that you see focuses exclusively on the publicly visible, almost like an iceberg, right? The publicly visible portion in the form of ETFs and passive index mutual funds that are registered under the 40 Act. The much larger part of passive is actually embedded in the rest of the industry, right? So it's everything ranging from what are called collective investment trusts, which are increasingly replacing mutual funds. They are unregistered 40 Act funds. It reduces some of the costs. They're able to offer them at slightly cheaper prices. Total return swaps are a tool that I use all the time in my trading that allow me to effectively create a synthetic instrument, right? Those often reference passive benchmarks. It's certainly the case in some of my work. Futures, separately managed accounts that an institution, for example, directs to be managed in a passive style. Those are all things that don't get counted in that, right? And so this is one of the challenges similar to some of the issues in the crypto space. We have a difficult time agreeing on where we are. There's actually a fantastic piece that's coming out of Harvard. I actually just got a preprint of it by Professor Marco Salmon that evaluates some of this. He actually used some of my work to create models of what his estimate of passive actually is. And he finds, similar to my analysis, that the bare minimum estimate of passive share in the strictest sense is about 39% of the market now, right? So it's a huge component, but that's not split equally, right? It's not like everybody has 39% passive. I have much less passive than most people do. You'll probably have much more because you'll be slotted into a 401k plan. That 401k plan will default into what's called a qualified default investment alternative, where the HR manager that hires you, whoever that lucky person is, will have made a choice for you to put you into a target date fund. And so the way the world is set up is while the baby boomer target date funds are the largest, right? I think actually the largest may actually be mine, which is technically not boomers, but it's, the 50 to 55 area, where you're expected to retire around 2035, right? So I would argue that it's not quite a boomer phenomenon yet, but the passive penetration amongst the younger generation is north of 90% now. The passive penetration amongst those over the age of 65 is only around 20 to 25%. So it's actually quite a bit lower than most people think it is. That means that there's two components that are going on. One is we're continuing to see money flow into passive vehicles, and the money that's coming out is largely coming from active funds. All right, this is devastating to firms like Royce or others in the mutual fund space who just increasingly have a bucket that loses assets but has no real mechanism for gaining assets, right? Because they don't compete. They have a very hard time getting into the programs like 401k plans.
Right.
And in many cases, IRA plans, because registered investment advisors are also faced with restrictions around what products they can use, right? As the industry is consolidated, there's fewer and fewer with discretion to pick, I think this fund is going to outperform and I'm going to put my clients into it. They're increasingly bound by the rules of fiduciary behavior, et cetera, that are guiding everybody from a regulatory framework into the lowest cost products, right? It's created, the liability framework has been created that basically means it's really hard to pick an active manager as either as a corporate sponsor of a 401k plan, or as an RIA or as an RIA into an IRA type platform, or an individual's direction. So, while everybody thinks the story about passive is one of performance, I would actually argue that they're missing the boat. One is all the money going into passive is actually distorting the market and causing the outperformance, right? And the second component is that the regulatory framework that's in place makes it almost impossible to change that dynamic.
Yeah, that's a great way to put it. Slapdash on Twitter wants you to step back to your takes back in 2016, where he believes that you were discussing the impact of passive, and you were hypothesizing that it might have the greatest impact on small cap companies due to consensus that small cap equities outperform in long term due to higher risk premiums. Two, that inflows into target date funds, which would be overweight small cap for millennials. And three, smaller float would lead to greater market impact of passive flows. Do you think this has been the case over time?
So this is one of the wonderful reasons why I went out and talked to people around the world and said, here's my hypothesis, show me why I'm wrong, right?
Yeah.
So my initial hypothesis on that was based on many of the leading target date funds and many of the allocations at the time, which overweighted small cap value as an index, right? So a very typical construction would be a portfolio that would be 50% allocated to US large cap equities. These are just rough proportions, and 10% to small cap value because of its historical outperformance.
Yeah.
Right. Now, there's two separate issues associated with that. One is that if I actually relate those two on a market cap basis, small cap value, instead of being in that analysis basically 1/5 the size of large cap, is actually about it's about 3% of the market, right? So it's actually a tiny, tiny fraction of the market relative to the S&P, for example, which is now over 90% of the market by market capitalization. So that's how I had approached the problem, was from thinking about it from that standpoint. The more money that goes into these strategies, the more overweight you'll see small cap become. What I failed to anticipate, and the reason why I've changed my views on that, are twofold. One is increasingly the world is dominated by Vanguard's total market index. So instead of choosing to allocate to small cap value, what we've actually seen is an industry that has shifted away from that over allocation towards a focus on, we'll just buy everything in proportion to the market cap, right? That actually has paradoxically reduced much of the investment in small cap value relative to where it was, and in my view, contributed to the underperformance of the strategies. There's also just this general bias amongst active managers to pick small and value, right? And as they get fired, I describe it in the post 2018 environment as, you're basically hanging out with losers, right? And I don't mean that in the terms of, I don't like small cap managers. It's not that I don't like active managers. Many of my best friends are, and it's one of the reasons why I find the industry dynamic so annoying, because these are brilliant, hardworking individuals who are genuinely trying their best. And the reality is that the setup of the system is just working against them. The second component that has been really definitive on this was the work of Corey Hofstein, and then supplemented further by, I'm blanking on Bouchaud's first name, but he built on Gabay and Koijan's inelastic market hypothesis with a microstructure interpretation of it that came out in February of 2021. And what he highlighted is that there's a mismatch between weightings that are done on a liquidity basis and on a market cap basis. And so almost in the inverse of what I had originally hypothesized, and this is a perfect illustration of how you can be really wrong in an analysis of something, his analysis suggests that if I look at it on a liquidity weighted basis, the greatest discrepancy actually occurs amongst the largest stocks. Very simple example: Apple, $2.2 trillion, $2.5 trillion in market cap, right? The smallest stock in the S&P is give or take $20 billion. On a market cap weighted basis, that would imply that Apple is give or take 100 times more liquid than the smallest stock in the S&P, but that's not the case at all. In fact, it turns out that Apple could be as little as 10 times more liquid than the smallest stock in the S&P. And so perversely, it means that the greatest impact is actually happening in the larger stocks. Again, I would caveat this with the observation coming from Jang at MSU, where the underlying dynamic is that creates beach ball-like effects, and then it'll pop and then reverse. And again, this is broadly what we're seeing in the market.
Yes. So just a memo, by the way, you do not hate small caps. Putting it out there.
I don't hate small caps. I don't hate active managers. I don't, it's actually where I came from. And I have a deep affection and love for people who are willing to dig into that stuff. I wish that I could go back to doing it. Candidly, my skill set in the area has probably atrophied to the point that I wouldn't be competitive as a small cap value manager. But the simple reality is that the setup of the system is not designed to allow that player to succeed, right? I mean, you guys are young enough that you play video games, right? Like, we all know these role-playing games where everybody wants to be a nth class wizard, and there's somebody who just for like ridiculous reasons is like, no, I want to be a third class mining dwarf, right? And you're like, but that character can't actually win. Like, yeah, I just like to be a dwarf, right? Like, there's an element of that to small cap value, right? It's fun, it's interesting, you get to do all the sort of traditional Ben Graham stuff, but the system is set up against you.
Yeah, that's a nice analogy. Last question is kind of a forward-looking one, and this one is from oh, my bad, got it, name wrong. This one's from Robert M. Dewey, and he wants to know, credit was the systemic risk that was triggered in the 2008 financial crisis. So what do you think the biggest systemic risk is now?
So I think the biggest systemic risk now is probably China. There are an awful lot of business models that are functionally built up around the idea of continued integration between the West and the East. And that appears increasingly at risk. And we're seeing that in supply chains, et cetera. We're seeing that in the fragility of the energy markets, which are incredibly built around this idea of free global transit under Pax Americana. I'm not one of the members of the globalization receding camps on a permanent basis. I think that this is a bump in the road. The simple reality is that our globe has gotten too small for us truly to fragment in the way that we would have in prior periods of deglobalization, right? And the reality is that those periods of deglobalization, for example, between World War I and World War II, are relatively small. We actually came through one of the biggest periods of deglobalization actually during the Cold War, where effectively the world split into, two separate regimes. And while we often think about the dollar as being the reserve currency to the world, the reality was that half the world's population never saw a dollar because they weren't integrated into that dollar system. Right. So I think that this is a temporary disruption. I think the thing that is scary about it is that we don't know what form it takes on the other side. My hypothesis, and this I could be colored by my status as an American, but my hypothesis is that America comes out of this a much less benevolent global hegemon than they went into it. And I think that's frightening. Yeah, it should be frightening to the rest of the world. It's certainly frightening to Americans.
Yeah, and that's just a follow-up. Do you, I'm at least looking at emerging markets, I feel like there's some potential for risk there, especially with, rising debt levels and what we've seen in Sri Lanka. Do you see this as potentially like a domino effect or cause for concern in other emerging markets?
As I've highlighted elsewhere, I think emerging markets are ridiculously fragile right now. And that is really what a deglobalization cycle means. It means those that have been integrated into the margins of the global trading regimes suddenly find themselves ostracized, right? Incapable of participating either because they can't access the funding that's required, or ostracized because they make the wrong political choice in one form or another. The alignment ends up wrong. That has catastrophic implications. I can give just a really simple example. A country like India, for example, obtains hard cash through exports of cotton.
Yeah.
Right. So instead of growing wheat, Egypt grows cotton for export, giving them cash, which then allows them to buy technology, medical supplies, and food that is grown more cheaply elsewhere. Mm-hmm. As we enter into this type of deglobalization cycle or logistical snafu cycle, it is increasingly unclear that India will have the funds required to buy food, which means they're plowing under fields of cotton and less efficiently growing wheat and corn and various other food stocks, right? That's a drop in living standards, right? And these are countries that cannot afford it. They simply can't afford it.
Yeah, it's a bleak outlook.
That's the area that I'm bleakest on right now. I mean, I'm going to flip it on the other side and tell you that I'm also seeing the signs that an incredible world sits in front of us, but it's achieved through growth, not through austerity, right? Growth and human ingenuity as compared to austerity. And, you've heard me use this phrase, right? Like, we keep talking about accessing a solar battery in the form of fossil fuels and forget whether you want to argue about abiotic origins, et cetera. But, the general theory of fossil fuel production is largely that it is biological in nature, that it is the byproduct of roughly 1 billion years of life on Earth and the accumulation of solar energy in the form of carbon molecules, right? Bonded hydrogen carbon molecules. What fossil fuels really are is we've just depleted a battery that has been charged over 1 billion years.
Yeah.
Right. Reliance on solar, at least Earth-based solar, is the most ridiculous thing ever, right? You're basically taking a giant nuclear furnace we call the sun, and you're capturing a pencil point of light coming from that and hoping that you can capture it for somewhere between 6 to 8 hours of the day using effective tracking technology, right? It means half the world is in darkness, half the world isn't. Like, this is just silliness, right? It's a really inefficient way to capture energy. But we also have things like that are increasingly emerging, like space-based solar, which can have 24-hour availability and mechanisms to transmit it. And we have this incredible thing. We've got these magic rocks that produce electricity when properly utilized, right? So, like, by any criteria that we're looking at, and we're also figuring out the very fundamental process of fusion, which may potentially be 30 years off into the future forever, but I don't actually believe that, right? The challenge with those sorts of technologies is once one person figures it out, then it gets solved and improved and millions of better things happen, right? So all of those things we're right on the threshold of those, and we need to figure out how we speed up and encourage that transition. And like, that makes me so excited and so bullish on the future of humanity and the opportunities for much higher living standards. And then I start talking to people and they start telling me, well, the Earth can only sustain 7 billion people or 1.5 billion people. And there's 7.5 of us here. And so it was inevitable that 6 of them were going to have to die off, right? It's like, these are our leaders, right? I mean, like, what terrible group of leaders would ever believe something like that?
Way to inspire hope. I lied. Last question is kind of a joke from Inflection. It's not even a question. It's more of just a statement. He never talks about sous vide anymore.
I sous vide on a very regular basis. Yeah. I occasionally assume people are sick of looking at my cooking. But no, so sous vide is actually, I very strongly recommend it to anyone. It's a really inexpensive process. Buy a $70 sous vide heater. I'm forgetting what they're called, but off of Amazon or at your local Target, and you can literally leave your food cooking for hours at exactly the right temperature. It allows meats in particular, but also vegetables, I know you're a vegetarian, to be cooked to absolutely the perfect consistency, exactly as you want them. You can take lower quality cuts of meat and improve the outcomes dramatically through the tenderizing process. And so for anyone who really enjoys cooking, it's actually just a really powerful precision method of doing so. And I love it. I think it's fantastic. I just don't share it all the time.
Yeah, that's all. It's all good. He hasn't forgotten about it. Awesome stuff. Thanks so much, Michael Green, for taking the time today. This was really insightful.
Excellent. I enjoyed it very much.
I hope you enjoyed that. For more content, check out the rest of the videos on my channel. And be sure to look out every Thursday for a new episode.